Hello, everybody. My name is Natasha Phipps. I am the CEO of WealthShare, and I'm joined this evening by the Atlas One team. We've got George Nass here and Lavelle Lindo here. Hey, guys.
Hey, Natasha, how are you doing?
Good. I was just thinking before we started, I think this is our last info session of 2025.
Wow.
Pretty crazy. The year has certainly flown by, but excited to be here this evening. We're going to do things a little bit differently tonight because we've got the Atlas One team here. But as always, yes, this will be recorded. Yes, we can share the recording. If you have questions, please reach out if you're watching the recording or if you're here this evening. Please feel free to put the questions in the chat and we'll address them as we go here. So, before we get started, the most important part of any presentation is our disclaimer. George, do you want to do
Yeah.
that for us this evening?
Yeah, so I'm also the Chief Compliance Officer of Atlas One, so I always get the fun part to do this. So, really quick, this is just a presentation. It's not actually a solicitation for sale. We'll talk about if you are interested in purchasing securities for WealthShare. We'll talk about how that gets done at the end of the presentation. Natasha will give a great overview of the WealthShare REIT, but she'll also be talking about some numbers. Some of them will be forward-looking numbers. Those are should be taken as is. Anything can happen in the future, and so please consult legal, financial, and other advice when making your investment decision. And then finally, there's obviously risks in terms of investing in exempt securities. WealthShare operates under what's called an offering memorandum. We have that available on the Atlas One website that describes the risks and disclosures. So please also review that before you proceed to make an investment. Lavelle will talk a little bit, about the experience of investing through Atlas One, and we'll address those particular issues when you do that. So back to you, Natasha.
Awesome. Thanks, George. I have to say too, we have been with Atlas One since WellShare started and closing on our 3 years. So that's really exciting. Thanks for that, George, and thanks for being here this
Yeah,
evening.
3 great years, 3 years of great performance too. So
Yes. Awesome. Okay, well, we're gonna kind of go over the WellShare offering and what we do and who we are, and how also have a bit of conversation with the Atlas One team as we do so. So, just real quickly, important to know like who we are, what is WellShare, and what are we doing? And we are a private REIT located in Calgary. Our mission is pretty simple. It's really to provide Canadians the opportunity to invest passively into multifamily real estate with an Alberta focus here where we are based in. And our goal is to offer a 12% annualized return to our investors. Later on, we'll talk about how we calculate those returns. But put simply, the values that we bring to the table are really about transparency, accessibility, and education. And we're going to dive into more of those as we go through, but really want to highlight the accessibility one is just, my background is as a realtor in the investment space, and it's getting harder and harder for every Canadian to even own their own home, never mind invest in secondary investment properties. So the accessibility to be able to invest into hard assets in Canada is something I'm really passionate about with my background as a realtor. And then, of course, this evening is an example of the types of education that we do. So we can't do this alone, of course. There is a team behind us here, and we won't dive into all of our resumes, but we all have a shared common vision of these goals, and you can learn more about each of us on our website at wealthshare.ca. But did want to highlight as well at the bottom there the trustee members. I think it can sometimes look like from the outside there might be one person making all decisions for a company like us, and that's really not the case. We have a total of 6 trustees that make all major decisions, and their sole goal is to work in our investors' best interest at all times. So understanding the who behind decision making of a company like WealthShare is really important as well. So if you want to learn more about our trustees, you can also do that on our website. And they bring great experience and expertise that we as founders don't necessarily have. So it kind of rounds out the experience and expertise on our team. I also want to say hi to Michael. He is here this evening, our investor relations manager, Michael DiPaolo. If you've heard from him recently, it's great to have Michael on board. I think we're almost at your, is it 1 year anniversary, Michael? Close?
We are, yeah. Yeah,
Yeah,
pretty close here.
getting close. So,
It's been a
yeah,
great year.
thanks for being here tonight as well, Michael. Okay, so let's talk a little bit about what a REIT does or what a real estate investment trust is and why it's used. It's really a vehicle that allows investors to pool capital towards a common goal. In our case, it is multifamily real estate, and but there is funds out there for all kinds of different things that you can explore, especially on the Atlas One platform. But it allows you to invest in something or a strategy that you might not be able to do on your own. And so it does provide other benefits as well in terms of transparency and accountability. And that's what's listed at the bottom here. So a few things is given our structure, we do have to do annual audits which is a huge benefit to the investors in terms of transparency. So annually, you know that a third party, an independent company, is actually reviewing our financial performance for the year. So it's not our internal opinion. It is a third party independent valuator. And that is a big one when it comes to consumer confidence and what is actually going on, behind the scenes every single day. So that's a big one. George also mentioned us being open to accredited and eligible investors. So, in combination with the REIT, we have an offering memorandum, which George was referencing, and you can read on the Atlas One platform. But that allows us to accept investment from eligible investors as well as accredited, which was really important to us to try to make what we are doing as accessible as possible. And that was what was required for us to be able to do that. So we love that. As well as we accept investment from coast to coast now, aside from Quebec. Quebec is a challenging one in Canada, but the rest of the country we pretty well have covered. And then, of course, the Canadian Securities Oversight as well is there is a lot of governance and oversight that is required by us, each and every filing, each and every document. There is processes in place to protect our investors and ensure that we are doing what we say we are doing. Anything to add, Lavelle?
No, you nailed that actually. That's good.
Awesome. Okay. Do you want to talk about this one a little bit, Lavelle? Like you speak to investors often, obviously, working in this space, and kind of what are some of the benefits that investors might like to a structure like ours?
Well, I mean, you got it right, and there's so many factors that make these types of investments really applicable to investors, and kind of why we like to introduce them. And when we talk about REITs specifically, there's different ways of deferring tax, obviously through the registered funds. But a lot of REITs, even the cash that they do spit out, is typically then classified as it gets classified more favorably just due to the flow through opportunity. So there's the REIT investment structure is a great one. It's a professionally managed portfolio. You get access to capital. Again, it's a larger pool of capital. You can buy more buildings. But really, the beauty about the REIT structure is, when you look at even your own portfolio and the diversification that you're able to capture with it, because you have this large pool of assets of capital, you can
Right.
go out and buy different types of buildings in different locations. And you can stagger the timeline as well so that on the exit, there's constantly something in the pipeline. So I think having the mutual fund structure that you have
Right.
and access to capital, it's a huge benefit to all investors in the structure.
Absolutely. I always relate this to like even like buying hard assets. The diversification piece is so huge. Like even if you were to go buy the real estate yourself, like if you're going to buy five pieces of property, you're probably not going to buy, five condos in one building. Like you're going to diversify and spread things out likely. So being able to diversify in things also that you're not maybe an expert at. Like I'm not an expert in the industrial space. And so being diversified in different types of strategies in my own portfolio it's a great way to be able to tap into those without having to do it all myself and learn all the ins and outs when I can just invest with those management teams that are already experts at it. So yeah, that's awesome. Um, okay, I love this slide. Why multifamily? There's a lot to talk about multifamily real estate and CMHC and the financing space, especially in the last couple of years. But I think why multifamily in terms of investors and what we're doing here at WellShare is what I'll kind of chat about. So multifamily, in terms of why it's different is how it's valued. There's a very big difference between how a multifamily building is valued than, say, your primary home is valued. And it's actually my favorite part about multifamily real estate. So my home that I'm in right now is worth whatever the market kind of says it's worth, right? There's a house that just sold down the street that impacts my property's value. And what I love most about multifamily is the valuation of it is a direct result of your net operating income, which is a direct result, quite honestly, as well, of how well you do your job in terms of managing the asset. So, how well something is being managed, could very differently be a different valuation right across the street, right? So, I love that it is a result of how well it's being taken care of and how well the management is being done.
I agree. And Natasha, I think that this is really the highlight of to me at least of the presentation, because it's the actual sector. And when you start looking at multifamily, understanding what it actually is even more important because multifamily is a specific aspect of the real estate market, which is different than what you hear from headline real estate news.
Yeah.
You don't hear about the multifamily market. You're hearing about the private family, the single family home market. You're hearing about our house prices. So real estate prices are up, real estate prices are down. That's us buying and selling our a single family home of a primary residence. Multifamily is the rental market. So if you cannot afford a home, this is again not even the condo market, which is owning.
Right.
Multifamily is renting. There's one owner, and everybody else is a renter in that building. So you're correct. It is a business, and so the valuation of multifamily is a calculation on net operating income. Like you say,
Right.
it's the
Yeah.
efficiencies and economies of scale. It's how well do you run a practice, and so then it becomes a matter of, well, who is the operator? And this is why you started at the beginning talking about who you were and what you do and the experience and expertise, because that's what you want to look for in the multifamily sector.
Absolutely. And you think about multifamily too. I mean, the more we grow, just as a quick example, even like an insurance cost, um, those efficiencies start to be really exciting as you grow as well. But the other thing is it is a long-term game. Like this isn't a short-term outlook. You need to be thinking long-term as well, and taking advantage of good management, making those tweaks on efficiencies, maximizing income, but also tenant retention, how well these properties are being maintained. So absolutely love that. I also love the hard asset, right? Being able to see, feel, and touch something. It's not a concept that is to be developed one day, 10 years down the road. Like we get investors that drive by our assets, like, hey, it's looking good. They're excited to see where their money is, and it's something tangible that they can see and feel today that is making money from day one. So Yeah, all great points. Okay, so how are returns made? How is money made in multifamily real estate or real estate? And I think we tend to what I hear a lot from investors, whether they're buying their own real estate or they're investing passively, really most people focus on cash flow, and that's the first thing they think of, and that might be the only way returns are made. But it is an important one. We want to make sure we're cash flowing and having positive income, but it's only one of the ways returns are made in multifamily real estate. So, cash flow, of course, is just what's left over at the end of every month. That would be your cash flow. But in talking about the other ones, my second favorite one is directly across from here, which is debt pay down, because whether you're just a single family investor, the debt paydown component is the most predictable part of real estate investing. You know, over the course of 10, 20 years, what that schedule looks like if you're just going to pay down that debt and let it do its thing, right? So that is extremely predictable in terms of even if the market is flat, does nothing, there's no appreciation, the debt pay down is very predictable and you can plan for that and count on it when it comes to hard assets, multifamily real estate. So love that part, but it's often the first thing people forget about, I find, is the debt pay down. And so, and then value add is a big one. Now, what I mean here on multifamily doesn't necessarily have to mean either like a big renovation or a big project. It could mean that, but could also mean just like if you were in the space of buying older buildings, let's say, and you added dishwashers and laundry to a unit, and that increased your rental income because you have features that people want. That increase of your income adds value to your property and gives you more equity, of course, as a result. So those value adds that you make they could be parking, they could be storage, they could even be things like allowing pets and other things in the property that will improve your net operating income. And the multiplier here is really quite surprising when you start looking at the numbers. So love the value add one. And then obviously passive appreciation over time, like what happens over time in real estate, things, tend to go up over time as well. But the last one too is refinancing, because I would say the biggest difference between the like multifamily space and the single family space is it is a game of financing. It is there's very much a strategy around how you best utilize the financing options out there in the marketplace, and it's an ever moving and changing target. But at some point, over the course of 25 years of owning an asset, that you'll have these refinancing opportunities that will allow you to unlock equity and refinance at that higher valuation. So all of that combined is how we get our returns.
So Natasha, as you talk about the passive appreciation, and that's the property value grown over time, you start looking, investors are looking at provinces across Canada and seeing, hey, Ontario's probably a little bit tapped out right now. BC's probably maybe at a high end tapped out right now. Talk to me about Alberta, and that market. What are you seeing in the Western Canada market trends? Where's the value and opportunity?
Yeah. I mean, passive appreciation, I always say, should be treated like dessert, not like your main course. It's not something you should be gambling on, right? And I think a lot of Canadian investors perhaps have been caught by that in the last couple of years here when it comes to their own active investing, because large Canadian markets we're seeing crazy large high passive appreciation numbers year over year, and then started sort of relying on this and truly being conservative with passive appreciation outlooks. And what you'll find is we are very conservative here with everything, is really the name of the game. That is really where true wealth is made in real estate, is being conservative. Passive appreciation, though, I will say, as much research I've done into many markets in Canada, but even here in Alberta, people think, well, there's maybe not as much passive appreciation here as other markets. Look at any 10-year snapshot of any Canadian market. Uh, it's really a no-brainer. Are you going to see a bit of this here and there? Yes, there's going to be short-term indicators. There's going to be things that arise, but over the long haul, just be conservative with couple percent appreciation in your analysis of things and be conservative and things make sense. And truly history has taught us that that is what happens. But in the short run, you might see some squiggly lines here and there. But for Alberta, I mean, the last couple of years, we've definitely stood out in the country as an opportunity for many reasons. And we have a lower cost of living. We're going to dive into that on the slide about Alberta, but the demand for housing has been substantial. So we have seen some high passive appreciation markers, but it's
Mhm.
important to be conservative on our long-term outlooks.
Awesome.
Okay. Talking about housing, we won't dive into this too much, but it's been obviously a topic. It becomes highly political. There's a lot of red tape when it comes to housing. There's a lot of debate around this, but overall, this has been a topic, and the problem a little bit is you can't call the Canadian real estate market, right? You have to get niche down, and wiping the whole country with one sort of brush or phrase doesn't really work. But the reality is especially here in Alberta, I mean, the demands for housing have been huge in the last couple of years. Today, we're seeing a more balanced market condition, but I mean, the influx of population into Alberta has been substantial. And what I do need to give Alberta very big credit for too is that removing red tape, getting projects off the ground. It's quick. Like we can do that in a matter of months here. It might take years in some of our counterparts in other markets. So Canada needs more housing, sure. Now we've seen some adjustments with obviously the amount of people we're taking into this country this year. But generally speaking, overall, like housing has become an unaffordable thing for a lot of Canadians. So that's what Canada really needs to pay attention to is trying to make housing more affordable for more Canadians to live where they want to live. And unfortunately, that has meant people have moving to Alberta purely for that, even just for that reason alone, just for the cost of housing. Okay. I know we both love this kind of slide talking about Alberta and why invest in Alberta. But it's also just like why are people moving to Alberta? I think one of the largest rules in real estate investing is follow the people. You follow the people, then you follow the Starbucks and the Walmarts and all those things. But all of that is driven by people. And why are people, looking to Alberta? And so why should I invest in Alberta? Really it's a rapidly growing real estate market, and not just the like two largest cities of Calgary and Edmonton, like even a lot of the secondary markets we're seeing significant growth in. But a few advantages for Alberta when we're talking about real estate, and that's this first one here. I get asked a lot, well, Alberta's just, it's just about oil, and that's all we have to offer here. And I will say, this has changed a great deal in my lifetime. It really used to be just every conversation was about the price of oil. And that has changed significantly, and we see it in our applications as well for tenants. We're seeing significant diversification in tech, healthcare, tourism, shipping and receiving and logistics. And we're manufacturing airplanes now west of Calgary or east of Calgary, sorry. We are manufacturing drywall soon. And so like these things that we all want to see more diversification, it is truly happening. And we see it on the ground with who we're talking to and who is actually moving here. It's more often than not related to the energy sector anymore, where it used to be like almost 100%, it seemed to us, were tied to that sector in some way. So strong diversification in the economy, which is really, really exciting. Open for business as well, pro investment policies. We have lower taxes overall. That does attract investment and also attracts people, right? People want to try to have more dollars in their account at the end of the month. That's just pure dollars and cents of it. The net migration into Alberta has obviously been substantial the last couple of years. Strong housing demand, strong population growth, and like we're attracting a high quality of Canadian too. Like really good people are calling Alberta home now and finding opportunities here in our growing diversified economy. Um, Strong GDP growth, of course. Quality of life is a big one too. I think since COVID too, like a lot of Canadians kind of took moment to reflect of what they want in their life. And lifestyle is a huge driver for people here. The last one around rental market. As a landlord, this is the most important one, probably just at speaking as a landlord. The ability to protect our investment in terms of fair landlord tenancy laws is really important. Things go wrong, and our process here in Alberta, when things do go wrong, is significantly smoother and quicker than what we're seeing in other provinces and have historically. No rent control as well, letting the market do its thing is a big one. Being able to raise the rent once per year, whatever the market will bear. And then even just the laws around like the types of tenancies we can have are just more favorable in terms of a more fair environment for landlord and tenant.
And a note on that, that's been the case for many years. And based on that, I know a lot of developers and issuers that are based out of Ontario, when they look to expand, BC's too expensive.
Yeah.
Saskatchewan, maybe it's further down the road. Same with some of the Atlantic provinces in New Brunswick, but Alberta is becomes the number one
Yeah.
option for expanding, a portfolio that's typically in other provinces. So
Mhm.
to your point, all these factors have seen a lot of investment dollars, a lot of wise eyes see it as a good opportunity as well.
Absolutely. So, what is our strategy? As we talked about with this vehicle, you can do all kinds of different things. We talked about multifamily real estate, and even within multifamily, that's a very wide umbrella of what you might want to do. You might want to develop multifamily, you might want to rehab properties. Our mission is pretty honestly boring. We want to acquire assets that are in new or newish condition, like not older properties. We're not trying to add variables. We're trying to thread the needle of less variables and solid returns, and that's really been kind of the goal of what we're doing. So looking at newer, newish properties has fit the bill. That doesn't necessarily mean that there might not be things that we could change about them. Like, we added storage on a property or something like that. You can always still have little tweaks and improvements, but having the more variables is the more risk. And the more risk means it's a little bit more challenging, of course, to predict exactly what our outcome will be. So we want assets that are going to be making us money from day one, that are in also areas in this province that we know do well even in some of this, right? Even some of the ups and downs of the rental market. You got to be thinking about when times are slower. Who am I competing against? What is this property going to stand out like in slower times? So that really is our goal. Turnkey, ish, buy and hold properties. We have acquired two court sales that were essentially turnkey because they were newer properties, but they did have a few little things that were unique because they were court sales. So um, that's really the goal. Turnkey acquisitions to lower the risk, provide those boring, slow, steady, long-term returns. That's really all we're looking to do. It's not reinventing the wheel, but it's doing it here in our backyard, in the prairies, and focused on our strong future here in Alberta. And that's really it. It's not super complicated or reinventing anything. It's just good, strong buy and hold real estate.
You hit it on the head, but I also like to go back to what your experience is because to me, every issuer has a specialty. They have a value prop, a proposition, or something unique about them. And I know in researching you and in hearing the feedback, you've got a very long, lengthy career in real estate, in that market, and in commercial real estate. And so to me, that's important. You can be a developer that's really good at construction, and that's what you've done all your life, and
Mhm.
and that's your expertise, and great. We will go for you for development projects.
Yeah.
Or you could be an issuer who has expertise in the real estate market, in transactions, in understanding off-market deals, things that don't even get to the market. You have the underground, network or the expanded network to be able to uncover some of these deals in a
Mhm.
province in secondary markets, which people who are outside of it, we really don't know what some of the best areas are. So, you know,
Sure.
share a little bit about that, right? Because to me, that's the selling point to people who don't know, the information that about these markets.
Absolutely. Yeah, absolutely. Very good point. I've been a licensed realtor in Alberta now for almost 18 years. I'm licensed in commercial and property management and residential. And just as my own, being a landlord of my own investments as well for over 20 years now. And that experience is really important through the ups and the downs and everything in between. And the one thing about Alberta is there's a lot of lessons that the changing market has taught us here. We've seen it all. We've seen it all from good, bad, the ugly. And in the last few years, we've been in this super hot market, of course, like we just talked about, and people investing from afar, and a lot of mistakes were made because they were only thinking about a very short period of time when things were super hot. And so that experience on the ground through every market condition absolutely has paid off, as well as the um, relationships. I mean, it's a very small world here in Calgary when it comes to the amount of people doing, they're active in this space on the commercial side, especially. So you kind of got to be in that group to be keeping your fingers on the pulse. So that's been a huge benefit for us for sure, up until today, and will continue to be. But one quick little example is I had a deal sent to me, thinking this might be a good opportunity for WealthShare, and this is it's in actually a decent part of downtown Calgary, and there's good development happening around it. This building is almost 50 units and has zero parking, none, zero parking, none at all, which may work. And it was built by a Toronto developer. That may work in Toronto, and it also may work here when vacancy is at an all-time low. But I can guarantee you, and we're already seeing it now, that decision is going to quickly become difficult when the market is very competitive and tenants can choose. Well, if I can choose with or without parking for the same price, I'm going to choose with parking, right? So knowing like Calgary is a driving city, most people here have cars. Are there people that are not sure? But that like why shorten your list to a very small pool of people, right? But I always think about what will this building do in the highly competitive times. We're all geniuses when things are hot, you know. So that's really, I think, what it's all about, and working with people in major markets who've been there and doing it really on the ground.
Mhm. Awesome.
Yeah, thanks for that, Mabel. Um, Okay, so maybe we'll just do a quick overview of the WellShare offer, and then we'll also talk about the last couple of years of returns, and then we'll also I think we'll share a little bit about Atlas One as well.
Sure. Do you mind if I talk about this? Because this is kind of a highlight to me. And when I mean, I've had the opportunity to speak to a ton of investors over the last number of months as they've come through Atlas One, and some of the, main questions come up with, well, what's the minimum investment? People at times don't necessarily want to put down a couple of $100,000 on a first time investment, but this is awesome. It's a $5,000 minimum investment. It's open to both accredited and eligible investors. And that's an important distinction. If you're an accredited investor, there's going to be better highlight. There's, obviously more assets that you put down. There's different um, uh, factors like currently right now there's a 10% bonus for $100,000 and more of an investment. That's not going to stick around for long. So that's really just a Christmas bonus that will come to an end. And really that's just a starter's bonus. The whole thing is that you now have a 3-year track record. And so you're not a startup anymore. We can go to the big firms and show a 3-year track record. So that's important. And so I think that 10% bonus is really just to celebrate the fact that you're moving into another phase as an organization, and really just crediting the investors who have been along early in the journey, if I'm not mistaken. And I think that that's
Right.
awesome, way of continuing to show investors that you're putting them first and you care, and this is absolutely going to be, a wise investment for them going forward.
Hmm. Hitting that 3 year mark, going back, obviously 3.5 years ago. So that was what came up in speaking to a lot of people who I look up to. It's like hit that 3 year mark and then come back to me.
Yep.
Yeah, like go build it and get a bit of a track record and show us kind of what you're able to do here. And I think this team has done an incredible job in these few years. But yeah, we're just getting through that like initial startup phase now. So excited for the growth phase next.
Yeah, I mean, you have a targeted 8 to 12% annualized return, right? And so anytime there's anything over 10%, you're winning. That's really what you want to be at. And a great thing about this is the registered account eligibility. So, I mean, that's all of them. That's RSPs, thinking TFSAs, you're thinking RESP accounts, right? Those are a 20-year time frame. You're thinking LIRAs, locked in registered accounts. Um, they're RIFs. So,
Mm-hmm.
there's all the registered accounts are available, and I think that that's important because when we start thinking about real estate investing and liquidity and redemptions and whatnot, well, you don't need it if you're real estate investing. When you buy a
Yeah.
house, you're buying it for a period of time. This is a passive way of buying real estate. And so, what's kind of neat is that there actually is not a lockup period.
Mm-hmm.
And that's different and very unique than a lot of these strategies. And one thing that I would say is a really awesome point for investors to note. Because you're going to want to be in this for the long term, and sure, there's redemption fees as normal, but when you look at the price of what the redemption cost is at $150 or less, right, for the redemption cost. And then you add the early redemption fee if it's within the 3 or 4 years again.
For the first 5 years, there's a sliding scale, which is pretty common in our
No, no,
competitors.
no. It's very common. There's
Yeah.
nothing outrageous there. This
Yeah.
is a great investment, for investors looking to be in a real estate fund that has growth opportunity in a diversified market outside of many current portfolos.
Absolutely. The $5,000 minimum, I think when we came to market, well, a lot of people said you're nuts. They said we were nuts for offering that, but that really speaks to what our very first slide of what our mission was, which was accessibility, um,
Ability.
and encouraging people to dip a toe, even if it's their very first time doing anything like this, because you're going to learn something. You're going to learn something that people you're working with and who you surround yourself really matters. So and we've already seen, like, people invest, they test it out, they build a relationship with us, and then they're continuing to invest or invest in other things that they've learned, being exposed to things like this. So
Absolutely.
we really believe in that low minimum, and we have a wide range of investor sizes, and the other thing is for registered accounts, I've learned a lot of people have what I call random amounts and random accounts.
Yeah.
You know, so many times I've heard, well, I wanted to invest, my 11,200 and nobody will take it or whatever. And it's just crazy to me. It's just like, why are we creating this barrier? Just because there isn't really a reason for it other than the cost to process the investor, I guess. But that's a big one. And then, the other thing is about we do get compared our offering to development funds a lot, which are a whole different thing. But what's important to think about when you're investing in something like WealthShare that does do an annual valuation is you will see annual net worth changes, annual growth on that, right? Because your unit price, your share price is valued once per year. So if you invest in a 10-year development plan, during the course of your investment is worth what you invested. That's it. You're not showing a growing net worth to your lender or whoever you're trying to show what your financial situation is to. So that's another thing that I don't think we thought about at the very beginning as being a benefit, but now we're seeing that and having those conversations with investors, and that's something that's important to them. They want to see that positive net worth growth.
Absolutely. Yeah, it's such a great point. I know that as we've positioned other funds in the past before, it was actually discouraged from being held on book at certain broker firms and bank firms because the advisor he has a drag on the portfolio for
Yeah.
5 to 7 years or 10 years until it pays out. When it pays out, great, it looks
Yeah.
great, but it's a drag on their actual performance and in similar returns, but um, with that valuation.
Yeah, absolutely. Just to note too, for registered funds, we do um, accept registered funds from Olympia, Odyssey, and Western Pacific. So it's not just one trust account provider as well, which is an important thing. And then the last point too around fees, whether you're looking at your statements from, your financial institutions or whatever, you do have to think about the fees. Any fees that you may pay with us are incorporated into kind of our operating. So you'll see on our OM, we have a management fee, of course, for example. Well, that fee is already included in our targeted returns. So we're not taking that after the fact, after we give you your investment returns. So the only fee you'll encounter on an annual basis with us is if you were using registered accounts, then you do need to have an annual fee with your account provider with Olympia Trust or Odyssey or Western Pacific. And that's about like 125 or ish a year in that kind of range, I would think.
Natasha, that's such a great point. I spent 20 plus years of my career in the mutual fund side, the stock market, open market side. And every time you set a return, it was okay. Well, you had to then go back and calculate what the fees were and what class you were, and were you an
Yeah.
advisor with this type of arrangement or that? And so they say, oh, it was 14%. Well, it was never 14%. Once you subtract tax and fees, it was, 11 and a half.
Yeah.
And so I think that you made such a great point that we you don't spend a lot of time talking about it here, but when you see the return, so that targeted 8 to 12% is net. That's an annualized net
Right.
return. That's after taxes, fees.
Our
That's
base
a net.
operate. Yeah. Everything.
So in everything, right? And so the total return that you get is a net return and what's advertised. So I think that that's also a very, very important point to highlight.
Absolutely. I was just going to pull up. Oh, well, show the properties. Okay, so what we have here is showing you the assets that we have acquired. 2025, we did review lots of properties this year, but I think it was smart to be a little patient this year. There was a lot of kind of like inflated prices and the lending environment, there was a lot of changes. So I think our patience is actually going to pay off here for us. But as you can see, these are the types of assets we're looking at, where we're looking at nice assets in good areas, and most importantly, they attract the right kind of tenant that we really really want. And that usually resonates with our investors. Like they want to know the types of properties that we are looking at. So as we've already reviewed all of these things, but why invest with WealthShare? Our low investment minimum, the management team, and then our targeted 12% annualized returns. And I'm gonna just make a note about the returns as well. So we're undergoing our 2025 audit right now. So Monique, our CFO, is just head down in the audit. It is a huge amount of work every single year. And it takes us a few months to actually get to the finish line on that. But once that's complete, we'll be able to let you know how we did for 2025. But 2024, we did a 12.6% passive return. And that, again, those are independent audited returns. And 2023 was 11.1%. And 2023 wasn't quite a full calendar year either. We had about 9 months by time we had everything kind of set up. So we're really excited to be able to share with you 2025 and have 3 years in our track record there as we move forward. Okay, do you want to talk about Atlas One a little bit, Lavelle?
I do. Atlas One started in 2021. Really, the focus, the vision was to bring self-directed investing to private markets and through real estate funds like WealthShare. So this is why we exist is to provide access. And Atlas One is we stand for the investor. We're licensed with through the exchange, Ontario, all the securities commissions across the country, and we work on behalf of the investor to ensure that suitability and compliance, to ensure that the investment is suitable for the investor. Along risk and timelines of investment horizon and all those factors. And it's important because typically the private markets were historically the domain of institutions and high net worth investors. And Atlas One wanted to change that. This is why I joined. This is something that I saw many years ago, just seeing the opportunity in this space. And so being able to be at what I call an aggregator, which is what Atlas One is, where a number of issuers can have their investments on our platform and have access to investors. And really, the point being is that no investor can have more can have a high concentration in
Yes.
one particular investment. And so I've said it for years, all the alternative companies are complements. They're brother sister, companies for investments because really an investor should have at least 8 to 10 different issuers or investments in their portfolio for true
Right.
diversification. And so, what I wanted to talk about is how we really, you know, um, focus on education of that and ensuring that investors are aligned with that. And Natasha, you do an incredible job with thought leadership content and educational content surrounding that and really investing in passive real estate investments.
Yeah.
So I would say I know I've read a guide that you have. I would recommend that one, I'm going to send it to the investors that I've brought onto the call, but I would say, all investors take a look at it and, answer the questions. It's pretty simple, but it'll help you understand more about passive real estate investing, what the opportunities are, what some of the pitfalls are, and what to avoid. But again, it's written by you and it's incredible content. So, again, just to your legacy of access and accessibility and education and thought leadership. I mean, you've actioned it out with some of these incredible pieces that you've put out to the market.
Awesome. Yeah. Thanks, Lavelle. Happy to share that always. And it's a little bit trickier in the passive side of things as well. Like if you're going to do due diligence on a home, like people know what questions to ask, I think, and what to look for, or how to compare a house by like the house next to it. But if you're comparing, WellShare to something else, what do I look for? And so that was really the goal of that as well, is to give people a starting point of like, what are some key things to look for? How do these things work? How are returns made? Who's making the decisions? Even like how is the debt being guaranteed? Like certain things, and who is the beneficial owner to the property? Because that's the other thing that we didn't mention about WellShare is our investors own 100% of the real estate. There's not a big chunk set aside for us as founders. We are here as stewards of our investors and management of the fund, but we don't have a big chunk of the real estate set aside for ourselves. And so those are questions though that you might not know to ask if you're kind of newer to this passive space. So that was the goal of it, was to get kind of the wheels turning of things that you might want to look for when you're out there in the market.
Mhm. No, really good. I love it. I mean, you're probably going to get into it, but just, what keeps you up at night? what could go wrong? And and more importantly, how have you prepared for such events?
Yeah, you always got to be thinking about, okay, what's the worst case scenario? What could happen? And like obviously barring outside influences in the world, I mean, I think in the multifamily space, the ch ever-changing lending environment is almost like to keep up with it is very difficult. Whether we're talking about insured mortgages or uninsured, is it's such a fluid space. Like there's constant change happening. So what might work 6 months ago very well could absolutely not work today. So trying to stay on top of all of that, staying in touch with all of that, really critical that we have the right team in place in terms of our lending partners. But so that goalpost is constantly changing about how you will finance a property. And the financing is the most critical in terms of like being able to predict our returns and be able to build out our business case, of course. So that's one of them. The other thing is how much you're leveraging a property. There's been a lot of media and marketing around, pushing loan to values as high as possible in the last couple of years and really over leveraging properties at the height of the market. So we were very aware of this and have never pushed the leverage to that point. And so having a buffer is really important when you're trying to build out a portfolio. So remaining conservative, just because you can get 50 years, should you on an amortization schedule, or is 40 or 45 maybe more reasonable and maybe you're not giving as much or trading off as much that you may not be able to change later. So really kind of usually finding kind of the path down the middle, not operating in extremes in any way is really I think what we all kind of try to do here. So being conservative is important too. And also, it's okay to not move ahead with something, if it's not going to work, we do not want to move ahead. We reviewed a lot of deals this year and they just don't make sense. And we would rather not do an acquisition just for the sake of it and risk our, targeted returns. So, it's okay to take our time, be patient. And then also just knowing that markets are constantly changing, right? So those are the kinds of things that we're doing here to mitigate risk, not over leveraging, being very conservative with our numbers, and tight management as well. So yeah, that's kind of the things that we try to focus
No,
on.
that's great. No, those are all very important and wonderful. I really like the fact that you talk about putting your pencil down when the deal isn't right.
Yeah.
Um, I think what we saw, I remember in the space, we saw it in 20, what are we in 2025? In 2022, 2023. I remember we saw that there were a lot of REITs that were buying because they were trying to get into the frenzy. They just didn't want to be left behind. And that all came to bed. That all came to hurt them later on when they realized they overbought, they overpaid. And a lot of the successful REITs, I remember talking to management, one of the things that they all stressed, and I noticed it, was when the deal is not right, it's pencils down.
Right.
And so when you highlight that point about how you prepare for things not to go wrong, uh,
Mhm.
that's probably one of the biggest things you can do because when you after you overpay, you're chasing for the rest of that project's lifeline, right?
That's right. Yeah, and it's really easy to get caught up in the hype of things, right? Like the no matter if you're a company or an individual, like there is pressure to grow and we want to grow. Don't get me wrong, but we need the right growth. And being able to deliver our returns is the priority. It is not how many doors are in this portfolio. It's what is the returns, and that's what we want to stick to, and prioritizing that each and every time is the point of all of this. So yeah, there was just lots of deals that just didn't make sense, and I predict that they will be coming back around next year, and
Right.
those deals might make sense. We love the asset, we love the building, we hate your
Right.
price. So being patient is also an important one in this game. It's not a race.
Well, that's awesome, and that leads me to really what was my final question for the night is what excites you about the current projects and pipeline, and this probably is what excites you. You know, the fact that these things are going to come around again, right, at different prices.
Yeah, it's a huge thing. I mean, here in Alberta, because we saw such growth, the rental demands were huge, and it took a moment for construction to catch up to vacancy. So, but it's happened, and we get projects pushed through really quick. So that is a pro and a con, depending what side of the coin you're on at what point in that deal. And so I'm extremely confident we're already starting to see this come through where projects are not going to work that were under construction because they were underwriting these projects at the peak of the rental market. And so those rents are not going to come in. They're not going to come in at what they projected a year ago when this building completes in spring of next year or something, let's say. So that's going to mean there will be opportunities. And those are the kind of opportunities that we want to be ready for and ready to execute on. And it is a strategic plan. And being patient, sitting back and kind of waiting, I think it was a good call this year.
Awesome. Oh, thanks so much. I know I'm excited to share your projects and your investment portfolio with the investors that I talk to. So, continuing to look forward to see that growth and that opportunity.
Me too. Thanks so much. And yeah, we have a great relationship with Atlas One. I mean, it's important to remember they're there to help you. They're there as an extra set of eyes outside of, the WealthShare group. They're there to ensure that your questions are answered, that what you're investing in aligns with what you're trying to do. So excited to have you here, of course, this evening, Lavelle, and everyone can put a face to the name that maybe hasn't met you yet as well. So this is the quick little snapshot as well of how you invest with WellShare and through Atlas One. And if there's any questions, of course, let us know. But I think that kind of covers everything I was planning to cover. And we're right on time, 7:00, Lavelle. Good for us. That's great. Um, this is just another snapshot of what we already discussed in terms of the offering, but everything is available on the Atlas One platform. You can make a profile there. You need to enter your name and your email in there, and you'll be able to see our offering as well as everything else on there. So I highly encourage everyone to get on the Atlas One platform and check it out. I don't know if there was any questions. Looks like George answered. So awesome. Okay. Well, we will wrap it up there then, unless there's anything else from you, Lavelle.
Great. Thanks for the time and thanks for sharing with us, Natasha.
Yeah, great to chat with you tonight. And thanks, everybody. If you're watching the recording, please reach out if you have any questions. We are 100% here to help you.